Before you apply for a mortgage, I want you to do something that most people don't do. I want you to try to qualify yourself first. And no, I'm not trying to turn you into a mortgage lender or the bank, right? But I also don't want the first time that you hear that your debt may be too high, or your income doesn't qualify you the way that you thought it would, or that your credit needs some work, or that you don't have as much money saved as you thought that you needed, to be after you've applied for a mortgage and someone has already pulled your credit. So grab your phone, open your calculator, get you something to write with, because we're going to check the 5 things that are going to give you a pretty good ballpark of how mortgage ready you are before you apply. Now, if you watched my last video, we talked about why somebody can be paying $2,000 or heck, even more than that in rent every month and still get denied for a lower mortgage payment. Well, today we're flipping that conversation around. And instead of asking, why didn't I get approved, or why did the lender deny me, I want you to ask yourself, what can I check before I apply? Because getting approved and actually being financially ready to become a homeowner are 2 completely different things. So let's figure out where you stand. The first thing that we're checking is probably the number that you think would be the easiest to figure out, which is your income. However, it's not always as simple as it looks. So first, I need you to figure out what your monthly income is. And I already want to stop right here because I know that a lot of you are about to make the same mistake. Do not open your bank account and go off of what hits every month to calculate your income. Okay, what you get in your bank account every month is generally your net income. And that's what you make after taxes and all of the other fees that come out of your check have been deducted. For this initial calculation, we're going to start with your gross income. And that's the income that you get before the taxes have been deducted. So let's keep our example really simple. All right. Let's say you make $72,000 a year. I want you to pull out your calculator, take that $72,000 divided by 12, and that should give you a $6,000 per month gross income. Easy enough, right? But that example is easy because I intentionally made it easy. This gets a lot more complicated if you're paid hourly. It gets more complicated if your hours vary from week to week or month to month, whatever. And it also can get very complicated if you're someone who gets majority of your income from commissions or bonuses or any other per diem income that you may be receiving. And if you're self-employed, that's a whole other conversation, because the amount of money that you feel like you make or even maybe hitting your bank account is not always the same number that the lender can use and document for qualification purposes. And I'm not going to dwell here too long, okay, intentionally, because I don't want to turn this into a 20-minute lesson about all of the different ways to calculate all the different forms of income. But just remember this, that different income types can require different documentation and history, and that is why you still need an actual lender to verify your numbers. Remember, we're not trying to become an underwriter and a lender and put our loan together all today, right? What we're trying to do is get a ballpark, know our numbers, know what our home buyer profile looks like before we go to apply, so that there are no surprises. So for today's example, we're going to keep our hypothetical buyer making $6,000 gross every month. All right. I want you to write that down, or if you're using your own numbers, write down your gross monthly income, because we're going to need that number here in a minute. Now that we have our income, we need to figure out how much of that income is already spoken for. And this is where we're finally doing the calculation that I promised you in the last video. Let's calculate our DTI. Now, debt to income ratio, or DTI, is basically comparing how much qualifying income you have with your monthly debt obligations. And that matters more than a lot of people think, because yeah, you can have this great salary and be making a whole lot of money, right? But if a big chunk of that money is already committed to other debts and other payments every month, then that can change the whole picture of what you can afford. Here's the basic formula that we're using. DTI equals monthly debt obligations divided by your monthly gross income. So let's go back to our hypothetical buyer. We know that they're making $6,000 gross for their monthly income. Let's take a look at some of their monthly debt obligations. So they have a $650 car payment, a $300 student loan payment, and a minimum payment on their credit cards of $150 total. Now, when we add all of those together, we have $1,100 in total of that person, our hypothetical buyer's monthly debt obligations. However, we're trying to buy a house, so we're not finished. Let's say we're looking at a house where the estimated proposed total house payment is $2,000 a month. We're going to take our existing monthly debt, which is that $1,100, and we're going to add it to our proposed housing payment. Okay, so take the $2,000 plus the $1,100, and now we're at $3,100. Now, after we have our total debt, we have our proposed housing payment along with all of our other obligations. Now we're going to take our total debt, including the proposed housing payment and our monthly debt obligations, which is $3,100, and we're going to divide that by our $6,000 gross monthly income. Okay, and that's going to give us a percentage. Now, the percentage that I'm getting is 51.7%. That means that our hypothetical buyer has a DTI of approximately 52%. Now, before somebody runs to the comments and tells me, well, I've heard that you have to have XYZ amount of DTI and this, and this, and yada, 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 and all the folks is saying, all right, I want you to stop right there, because no, sir, no, ma'am. Okay, that's not what I'm saying. There is not one magical DTI number that is going to guarantee every person a mortgage approval. The allowable ratio can depend on things like the loan program or the lender's requirements or the overall borrower's profile, which will allow for them to have a higher DTI, or folks may have to have a lower DTI. It all just depends on you and your situation. So don't use this video as a way to already have approved or denied yourself, okay? We're using this calculation as a readiness check, right? Because imagine you do this calculation and then you go to get approved and that DTI number comes back much higher than what you anticipated. Instead of getting discouraged and immediately thinking, well, I guess I'll just never buy a house, I want you to ask yourself, what's driving that number? Look at the obligations, okay? Look at your monthly debt. What's moving or driving the needle? Is there one large payment that's eating up a lot of your gross monthly income? Or are they several small payments that are adding up to a large amount? That's the information we want, and that's why we're doing this. Because if DTI is the problem, we really could have a whole conversation about what debt to address first and which one's really going to move the needle and make a difference for you. Now, that's not today's video, but I'll be sure to make one cater to that if you all are interested, so that, again, you can be prepared when you go to have a conversation with the lender. You're not walking into an approval like, oh, please give me a mortgage. Please, I need a mortgage, right? We want you to get approved, but you'll be more educated and know what's going on with your own profile and finances before you go and have a lender look at anything. Your job today is just to know your DTI number and understand which of your debt obligations are driving that number. Or another way to say it, which of your debt obligations are eating up a majority of your income. Here's another place where I see a lot of people make mistakes. They may calculate their DTI and think it's too high. They don't like what they see, so they start throwing money at random accounts trying to fix their credit. All right? No, that's not what you should do. Before we start spending any money trying to fix the problem, let's look at what we're actually working with. Now, jump into number 3. We're going to talk about your credit, okay? And I don't want you all looking at an app and automatically deciding that you're good. Experian, all of the apps that they've come out with to help you monitor your credit are great, all right? But that's not the end-all be-all, especially when you're trying to get approved for a mortgage loan. Don't base how good you are off of a credit score that you see. Okay, I want you to look at what's actually being reported every month. The way that I do that, you can go to myfreeannualcreditreport.com and go in there and pull all of your reports for each credit bureau, TransUnion, Equifax, and Experian. Okay, go through and really look to see if there's any inaccurate information. Where are the high balances at? Do you have any collections? Look for any late payments or any accounts that you've opened recently. And definitely look for accounts that you don't recognize. Okay, if you watched the video before, you know how I feel about blindly disputing things, right? But disputing or disputes when it comes to credit, that's what they were created for. If it's something on your credit report that isn't yours, you didn't put it there, it's inaccurate, you dispute those trade lines to get them pulled off because they're really not yours. They don't belong to you. If something is genuinely inaccurate, that's one conversation. But don't hear somebody online say, well, just go dispute everything. It worked for me. And then you go put all of these disputes on legitimate accounts because you're trying to buy a house. We're not doing that. Okay. Your goal is not to make your credit look better for 5 minutes. You're trying to become financially stronger so that you can build a better profile so that the bank or whoever will be more willing to lend you the money that you want to go buy the house that you want. And again, okay, I'm intentionally stopping myself here because there's a lot of videos that can be done on credit disputes and collections and credit collecting and what you need to look at on your credit. All right. But today's video is not for that. All I want you to know for today, for your mortgage readiness check, is what's actually on your credit report. Because let me tell you, you do not want the lender discovering something that you don't know is there. All right? Because they're going to ask you, and when they say, hey, what's this? And you say, I don't know. Well, they don't know either, y'all. That's something you got to figure out because it's your credit. You feel me? Okay. So we're doing good, right? We know what we make. We've calculated our DTI. We've looked at our credit and know what's going on there. Now I'm going to ask you to do something that a lot of people don't like to do. All right. I'm going to ask you to open your bank statement, open your savings account, wherever you keep your money or the assets that you have. Because jumping into number 4, we're going to look at how much money you actually have available to buy a house. Let's say you've opened your savings account and you got $20,000 in there. Good job, y'all. Okay? Great job. Especially in 2026 in the economy that we're in. Okay? That sounds pretty good, right? Now, for a lot of buyers that are in the market to buy, this is where most people start thinking, okay, well, how much of this am I going to need for my down payment? But I'm here to tell you, okay, that your down payment is not the only money that you're going to need when looking to purchase a home. All right. You've got your down payment. You've got closing costs. You've got prepaid items like appraisal and inspections and surveys and all of those good things. Then you've got moving expenses once you've moved in the house. And then all of the things that come after you've gotten the keys. Now, I can't tell you the exact amount that you're going to need because that's going to vary significantly depending on the property that you've bought, where you've bought that property at, the loan program that you used, the lender that you went with, and the credits and things that were negotiated on your behalf for the transaction itself. So the numbers I pulled and that I'm about to use are purely an example. But let's say between buying a house and moving in, our hypothetical buyer expects to spend about $15,000. They started with 20, they spent 15. So that means after closing, they have about $5,000 left. And that right there, the $5,000, is the number that I really want you to think about. Because getting the keys is not where home ownership expenses end. To be honest with you, it's really where they start. Okay? Because imagine 2 weeks later, maybe the water heater goes out, right? How does that $5,000 feel now? Or the AC starts acting crazy, or you discover a leak, or life and everything around you just happens. That's why I don't only want you looking at your savings and asking yourself, do I have enough money to close? I also want you asking, how much money or what am I going to have left over after I close. Because right now, before you start the process, before you apply with anybody to get approved, evaluating whether buying this house could completely wipe all of your savings out is a very important factor to take into account. And I think it's one that a lot of homeowners don't think about, which is why you see so many videos about homebuyers saying, I didn't know all of the hidden costs that came with home ownership. And I bought my first home and a year later I regret it. Because y'all, buying a house is expensive. Living in a house and maintaining a house is expensive. And as I said a minute ago, when you buy that house, it's really just the start of your expenses. Because now it's your responsibility. So it's nothing to be scared of. I encourage home ownership on this channel. Okay. This is a buying a home, moving to Texas home ownership channel, right? But I want you to be an informed buyer and not regret the decision you made a year from now, which is why I focus so heavily on being ready to buy and thinking about these things before you do. So that brings us to number 5. Okay. And this is the one that I personally care about the most, because you can pass all of your lender's checklists and all of their tests to get approved, right? But can still fail your own. And number 5 is to stress test your payment. All right. And this might be one of the most important calculations that we do today. Let's say you go through the whole pre-approval process and your lender tells you that based on everything we've seen and reviewed, we believe that you can afford and are going to qualify you for a $2,600 mortgage a month. Yay! We're buying a house. We're buying a house. Okay? But celebration over. And I want you to forget what the lender said for just a second, because now I want to know if a $2,600 mortgage payment will work in your life. Not the lender spreadsheet or calculation or what they said, but your actual everyday life. Let's say, for example purposes, that after taxes and all of the deductions, you bring home about $4,800 a month. Now let's start looking at the full picture of real life. You've got that $2,600 house payment. What are your utilities going to look like? What's your car payment? Groceries, gas, insurance, childcare if you have it, shopping, savings, entertainment, subscriptions, eating out, hair, all of the things, right? Whatever you like and actually spend your money on. Don't build your budget around this imaginary life. Okay, this imaginary you that's never going to go anywhere, never going to spend any money, never going to go out and live their life. Okay, but the realistic version of yourself. Build the budget around the life that you live and not your life around the budget that you want. Because the lender is only answering one question, and that is, how much are we willing to lend you? I'm asking you a different question, a more important one. And that's, how much can you actually comfortably live with? So again, let's say your lender says $2,600 work, right? But then you look at your budget and realize that at $2,600, you're not really saving any money. Every unexpected expense is becoming stressful, and you really can't do anything that you want to do. You're sitting in this beautiful new living room eating bologna sandwiches, okay? Because every dollar that you had went into buying this house. No. I don't want that for you, okay? So that's when you rerun your numbers, all right? And you say, well, actually, I think $2,100 may be more affordable for me, because at $2,100, I can still save. I have room for emergencies. I still have room to live my life as I was before. You can go out sometimes, you can enjoy yourself, and most importantly, you can sleep peacefully at night in a house that you know you can afford. Guess what? $2,100 might be your number, okay? Just because someone is willing to lend you more does not mean that you have to spend more. And I really want my first-time homebuyers to listen to this, because you don't get a trophy for spending the max of your approval or going out and finding a home at the top of your approval. Meaning, if a lender approved you for a $300,000 house max, you go out and find a $300,000 house. You don't get a trophy for that. Nobody's going to be standing at closing with the banner that says, congratulations, you spent every dollar that we had, right? Because when it comes time for you to pay that mortgage, nobody's going to be there for that either. The win isn't buying something that's big and beautiful, but out of your budget. But the win is buying something that actually works for you, your life, and for you to still enjoy your family and all of the beautiful things that come with home ownership without being stressed out. So let's put everything together. Before you apply for a mortgage, I want you to check these 5 things. Number 1, do I have a realistic understanding of what income may actually be usable? Number 2, what's my approximate DTI and what's actually driving it? Number 3, what's actually on my credit? Number 4, how much money do I actually have available to buy and what's going to be left over afterward? And number 5, what housing payment is actually going to work the best for my life? Now, let me tell you something. If you've walked into a conversation with a lender knowing these 5 things, that conversation is going to go completely differently. And I guarantee you, that lender is never going to forget you. They're going to be very impressed about what you know about your own situation and are going to be able to help you a lot more because you have a realistic understanding of where you stand. So they're not spending as much time trying to get you to be realistic, but more time coming up with a plan that you can implement to either get you to where you want to be or to get you into a home with what your budget will allow you to get into. Instead of walking in saying, please, can I buy a house? Please, will you give me the money so I can go buy a house? Right? You're walking in saying, this is where I believe I stand. Now let's verify it. And I love that position, especially for a first-time home buyer. You're educated, you're prepared, but you're also allowing the professionals in that space to verify and check the things that you couldn't check yourself. Now, if you went through these 5 checks with me and you're not really liking what you see, that's okay, because now we know where the problem might be. If it's DTI, we work on DTI. If it's credit, we work on credit. If it's cash, we build the cash. If it's the payment, then we reevaluate the price point. That's information. And I'm going to continue to break these topics down because, like I said, each one I hit on today really deserve a deep dive in their own video and own attention to that subject. Because I want us to understand not only how to get the house, but how to also make sure that the house makes sense once we have it. So before you leave, I want to ask you something. After doing all of these checks, which one do you think is going to be your biggest obstacle? Is it your income, your DTI, your credit, your cash, or finding a house within your budget? You don't even have to explain your full situation in the comments if you don't want to. All right, just leave one word down below. And if credit was the word you were about to put in the comments, I especially want you to stay tuned for what we're about to do next. Because week 1 was about figuring out whether you're mortgage ready before you apply. But one of the quickest ways that people count themselves out of home ownership altogether is by looking at a low credit score and saying, well, my credit is too bad. I'll never buy a house. But the bigger question is, what does my credit profile actually look like? What needs to change? And are you willing to prepare before you try to buy a house? So don't leave this playlist here, because remember, becoming a homeowner is not just the goal, but staying a homeowner is. When you know better, you definitely buy smarter. Until next time, see you in the next one.